So I formally welcome you to the Share Trading Investment Program. This is lesson 1 where we're going to be kicking things off, a world of opportunity. Let's get stuck into it. So taking a quick look at the objectives that we'd like to accomplish at the end of this lesson is the awareness of why we want to learn how to invest in the market in the first place. And then we'll be getting onto learning the differences between real world trading, and then we'll be getting into developing a clear understanding of market basics. You cannot participate in the marketplace unless you have confidence in understanding the basics, because understanding how to define value in a stock pick or read the analysis on a technical side of a specific stock is one thing, and it's a very important part of the decision making process. But understanding what goes on behind the scenes and what actually makes prices fluctuate, what makes the underlying value of a stock increase in value or decrease in value, is vitally important as well. So without further ado, let's get into core topic number 1, and that is, why are you here? What do you want to achieve in the market, or what brought you towards doing this course in the first place? Well, let's look at a few options. Maybe you want to make money long term with some short term or part-time investing decisions, right? Maybe you're just someone who wants to learn the markets and become an active and profitable investor. Maybe you want to improve your current trading and investing because you're not currently successful in the system that you're using. Maybe you also want to just find an active career path into the financial trading and investment sector. So if you fall into one of those 4 categories, welcome to the course. This is going to be an amazing journey for you, and I can't wait to get fully submerged in all the amazing content that we have laid out for you. So let's continue. Alright, it's time to get stuck into core topic number 2, and that's going to be trading and investing. I love this little portrait of Ray Dalio. A part of what you can do as a part of your homework at the end of this lesson is to go research who Ray Dalio is, and I'm sure you'll be very surprised by the information you find. One of the best investors to date in history, that's for sure. Alright, so let's look at the differences between trading and investing. So both involve seeking profit from the markets, but which side should you be on though? That's a question that many people ask, especially getting into the marketplace for the first time. Well, let's define the two, and then I'm sure you'll have a little bit more clarity on how we look at trading versus investing. Starting off with investing, as I'm sure you already understand, investing is the action of buying for long-term gains. It's about understanding how to define the value in a stock pick and then making a buying decision on a certain amount of shares that you can then hold on to. And if the underlying value of those shares increase in value over time, then so does the value of the amount of shares that you hold, to which then you can decide to sell those shares for a profit or maybe continue holding on for longer term gains. When we're looking at investing, we are considering the future value of what it is we are dissecting the value of, okay? So we are looking at what the future price could potentially be and looking to maybe gain the potential of the rise in price or the rise in value of our specific stock pick so that we can sell at a specific target, right? Investing generally relies on fundamental analysis. So it's not only based on what's going on in a micro scale in a company, so their company reports, who their CEOs are, who their board of directors are, what their cash flow is like, what their assets are like. We're looking at the macroeconomic environment around that company as well. What's happening within those sectors? Are there external influences that could affect the performance of that company? So we need to look at all these fundamental influences in order to make a proper investment decision. You need long-term growth opportunity in order to see any sort of financial gain from whatever it is that you're investing in. You must own the instrument being invested in. So when you're investing into a company, for instance, you're essentially buying a little bit of that company itself. So you have to own the share in order to benefit from its future valuation where you can sell at a later point in time, because if you don't own it, then you have nothing to sell. As with anything in the financial markets, investing is going to be sensitive to news. We can always see price fluctuations occur depending on what is happening in the fundamental news sector, which is why studying fundamental analysis is going to be such a key element to our success as budding investors. So let's have a quick look at how we define trading and how it differentiates from investing. So trading is the art or action of buying or selling for short-term profit gain. And we talk short term, we're talking on a weekly or even monthly basis, or even sometimes day to day. All right. We can make money as traders in both upward and downward moving markets, and that is generally based on the fact that you're trading contract for differences, CFDs, all right? When it comes down to the timing of our purchasing decisions based on how many shares we would like to include in our portfolio, then we're going to be relying on technical analysis, because timing is absolutely crucial in any financial market instrument trading approach. So we need to make sure that not only are we determining the value correctly, but that we are buying a certain amount of shares to add to our portfolio at the perfect time. Fundamental analysis will help us determine the value, and technical analysis will help us define the timing behind our purchasing decisions. So in trading, you don't need to own the instrument in order to trade it, generally because it's a CFD, a contract for difference. So you're putting up a portion of your own account value in order to speculate the future price movements of what it is that you're looking at. Let's say you're looking at the currency market, for example, you're looking at Euro USD. You could determine if Euro is going to go up or down based on your own speculative views and your strategy that you're using. And if you're right, then you'll be able to benefit. So if you make a buying decision and the price of Euro goes up against the USD, then you'll be right and you'll gain a certain portion of capital from the markets based on how much risk you added on that trade. Or inversely, if the market goes down and you've made a selling decision before that happened, then you'll be right to a certain degree and also be able to gain a certain percentage based on how much risk you've made or applied to that certain trade. Yes, trading is also very sensitive to noise. So if you are looking at any sort of charting behavior and there is some sort of news that comes out as a huge fundamental influence, then we will see the price fluctuations on the chart that we are looking at as well. Let me help you understand that the purpose of the financial markets and a company listing their shares on a stock exchange is for them to mainly raise capital. That's their primary objective, so that people can buy into their company and buy into their future valuation and their future growth, be a part of that company's growth essentially, right? Another big reason that a company will list their shares on the stock market is so that they can transfer risk. So they list their shares on the stock exchange in order to get investors interested and raise the capital for them to use to actually broaden out into different opportunities and expand a bit as well. Now, a company listing their shares on a stock exchange is a great way for them to discover the value of their company. And that's through price discovery of the shares being listed, right? So the more people who buy shares, the more money the company essentially makes, and the higher the price of the shares inevitably come. And then there is the transfer of liquidity and international trade as well. And this is just a very brief overview as to why companies list their shares on a stock exchange, to create some sort of interest from investors to help benefit the company's growth and overall development as well. So Warren Buffett famously said, "Price is what you pay. Value is what you get." In order to participate in the stock market successfully, you must be able to understand what you can invest in, and you also need to understand how you analyze and when do you actually trade, and then how do you actually buy and sell. So how do you find the value, determine when the right time is, and then pull the trigger on a buying decision. You need to know how much a stock costs to purchase is not necessarily a true representation of the stock's true value. So you need to understand that it's not going to be judging a book by its cover process. If you had to see Mark Zuckerberg walking on the side of the road, you definitely wouldn't assume that he was the billionaire who created Facebook, right? You would assume just by the name Mark Zuckerberg is someone who probably wears a suit and goes to very important meetings and spends most of his time sitting around boardroom tables. But he's very far from the average billionaire. And for this reason, we should not judge a book by its cover. And there's an equally valid saying for the investor, and that is, don't judge a stock by its share price. When we talk about future valuation, we are not talking about a stock price's current value, all right? And they may be towards the bottom or middle, still on their way up as a company, and you need to be able to determine if a company is undervalued, which means that their stock price is low but their future valuation is high, and that's what we call value-based investing. So most people incorrectly assume that a stock with a low price is cheap and worthless, while another one with a higher price is expensive. A stock's price says very little about a stock's true value. So current price does not dictate whether the stock is heading higher or lower in future, right? So we need to look for companies just like that who are trading lower and have massive potential in the environments that they're going to be operating later on. So there are some key points that I need you to remember regarding price and value. A stock's price indicates its current value to buyers and sellers, and you can highlight current, not future, current price. Intrinsic value may be higher or lower based on the company's advancements or the certain risks they take to grow and develop into the industries that they operate within. Successful investing overall is the art of identifying stocks that are currently undervalued by the market. And we're not talking about the investor. The investor is interested in the intrinsic value. The market is focused on the current price. Just as a little bit of extra information that will keep you busy between now and your next lesson, I would like you to research the definition of value investing in your own time.